Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 322 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including last Friday's tariff-related sell-off, stock performance in the fourth quarter, earnings expectations, and understanding mortgage rates. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So we will jump right into it. Joining me today is Nick Whitaker. Nick is a active fill-in for Matt. Matt's out of the office currently. So Nick, thanks for filling his seat this morning.
Yes, good to be here as always.
Pretty, I don't want to say erratic, but there was a lot of activity in the markets over the past week, really probably the most since early April. So we're going to talk a little bit about that here in a little bit. But before we get to that, we want to go through the major market indices that investors track. This data is from YCharts and as of the market close on October 15th. S&P 500 index down 0.3% so far for the month of October and up 13.4% for the year. The Dow Jones Industrial Average down 0.3% for the month and up 8.7% for the year. The NASDAQ Composite Index flat for October and up 17.4% for the year. The Russell 2000 Small Cap Index up 3.5% for the month and up 13.3% for the year. And the Vanguard All World X United States ETF is up 0.8% for the month and up 25.3% for the year. 3-month Treasury rate at 4.03%, the 2-year Treasury rate at 3.5%, and the 10-year rate at 4.05%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Moving on to big headlines, current events from the past week. Like we touched on, Nick, the S&P 500 dropped 2.7% last Friday due to the resumption of trade tensions with China. President Trump announced he would impose an additional 100% tariff on Chinese goods effective November 1st and impose new export controls on critical software. This re-escalation in the U.S.-China trade war rattled markets on Friday, especially for tech and semiconductor names that are a little more sensitive to global supply chains and export rules. However, over the last weekend, Trump and his administration walked back his initial comments that he made. That were the comments that spooked markets last Friday. So this week has been relatively positive for the most part. However, volatility is still elevated. So I think it's still kind of this environment where we could go either direction relatively quickly. We could break out to the upside and resume, the market's performance that we've had over the past 6 months, or we can kind of move to the downside. And I think a catalyst for that could be earnings season that just started this week. It got kicked off with the major banks reporting. So names like Goldman Sachs, JP Morgan, Bank of America, Wells Fargo have reported this week. So that could be the next catalyst for this market is how earnings season goes over the next couple of weeks.
And to put that into a bit of perspective, as far as that 2.7% pullback, the market has pared some of those losses. So from that pullback, we're now only down 0.75, 0.76 from that. So we've come back a little bit, and like you said, now it's kind of looking forward to earnings and seeing how that shakes out.
Right. Well, moving on to tweets, articles, and research from this week. The first thing I had was a post on X from Subu Trade on October 11th. That name always makes me chuckle for whatever reason, but he puts out some really good content a lot of the time. So
I always think Subaru.
Yeah, that's exactly what I think too. It's a good point. So Jenna will throw this up on the YouTube page. It'll also be in our show notes. But he says on Thursday, the S&P 500, this was last week, was at an all-time high. On Friday, it crashed more than 2.5%. Such quick pullbacks from all-time highs always saw the S&P go higher 3 to 12 months later. This is not the end. And again, he just highlights all of the instances where S&P, after falling 2.5% shortly after making an all-time high, the forward returns associated with that. And as you can see here, Nick, 6 and 9 months later, S&P 500 has been up 100% of the time. And 6 months later, on average, about 10%. 9 months later, on average, about 11.5%. Now, I will say it is a relatively small sample size. So we got 1, 2, 3, 4, 5, 6, 7, 8, 9 separate times that this has happened since 1955. So take it with a grain of salt, but I thought it was just interesting that he threw this out there, given we had kind of the most volatile day in the markets that we've had over the past 6 months.
Mm-hmm. And the other thing that jumps out to me about this sample set, and this goes for every piece of data that I'm looking at across those few pieces of data, the pullbacks where it is red on the screen that I'm looking at, they're not scary numbers. We're talking, I think the biggest one mid 3% pullback,
and most of it comes within the first couple of weeks after this happens, right?
Right.
And as we always talk about, markets over the short term are very, very unpredictable, but over the long term, kind of the opposite of that.
Yeah, and a 3% pullback is, we talk about that all the time. That's healthy. You expect to see those kind of pullbacks, even 5, 10% at different points in the market. It's good to see a little bit of pause, if you will. So
yeah, especially after the run that we've had over the past 6 months.
Exactly.
So, next thing I had was a blog post from Ryan Dietrich on October 1st. So I just wanted to pull one graphic that he had out of this blog post, but highly encourage everyone to go read it. It's called "A Quarter for the History Books, Now What?" and it's on the Carson Group's website. Again, this graphic shows the average performance of the S&P 500 on a quarterly basis from 1950 through 2024. And it is very clear when you look at this graphic, Nick, that Q4, so October, November, December, tends to be the strongest quarter of the year on average, up 4.2% on average and positive, 80% of the time. So again, this could be one of those years where we're in the 20% and Q4 is not positive, but I think always going into the fourth quarter, there is a lot of optimism going into the end of the year. And a lot of that, I think, is driven by earnings that we're about to hear for Q3. And that's kind of what pushes and drives these stocks higher into the end of the year. Really quickly, before I get your feedback, Nick, my last topic is kind of similar to this. It was a post on X from Michael Noss, CMT, on September 13th. He says, everyone talks about the weakness in September. When that weakness fails, however, it seems to be a better signal. So what this shows is that when the S&P 500 is positive during September, the fourth quarter tends to be that much stronger. So with that being said, would love your comments, your feedback, given the fact that this year, September was a positive year, surprisingly to a lot of people, for the markets.
Yeah, I think the 80% of the time is that really jumps out to me. It's quite the exuberance, when you're looking at this chart, you're like, oh, okay, Q4, here we go. It makes sense having been in the market a decent amount of time. Q4 really does tend to kind of pick up a little bit, and maybe it's holiday exuberance of market participants, and people love Christmas and Thanksgiving, and I couldn't tell you exactly why the trend is. Could be the end of year projections, and like you mentioned, earnings kind of kicking it in. But the chart kind of speaks for itself. 80% of the time, the fourth quarter is doing well.
Yeah, and another interesting piece that I think we can add on to everything that you just listed is, for whatever reason, when we do go into a bear market, October is the month that has the most amount of occurrences of the bear market ending in October. Okay, so it's a very random stat. Ryan Dietrich talks about this all the time. But when you have those bear markets or those sell-offs ending, usually you get a pretty decent run for a couple of months off of that low, and that could be another reason why Q4 is head over heels a lot more stronger than any of the other quarters, because throughout history, again, I don't have a explanation for this, but it seems October seems to be a month where a lot of the bad stuff tends to end, followed quickly there by some good strong returns off of the market low. So I think it's good news for investors that we've made it to Q4. At one point in the year, it was looking very bleak and negative, but it just goes to show you how quickly things can change in the market.
Yeah, the market can always change on a dime. That's part of the fun.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
So I have a couple pieces here, and they're all really themed around earnings. And as we just talked about, earnings are starting. The banks and some of the financials kicked it off this week. And I didn't intend to have a themed earnings series for you guys, but it just kind of happened this way. So I hope you enjoy. The first piece of research I have is from FactSet. This came out actually 2 days ago on the 14th. And the piece says in 37 of the past 40 quarters, the actual earnings growth rate reported by the S&P has exceeded the estimated earnings growth rate at the end of the quarter. So every quarter there's estimates from companies that come out, and then the sell-side researchers, basically people who are writing reports on the companies, will put out their estimates as well and see where the street is going to meet consensus. And what this chart is showing is that historically, over the past 37 of 40 quarters, the S&P has beat those estimates, which is a pretty good run. And so you can see there's a chart and there's some data here that right now for this quarter that we just started reporting for, the end of quarter estimate right now is about 7.98%. That data is going to range a little bit based on who's pulling the data and what you're looking at, but it's going to be in that 8% range. So that's kind of what we're expecting the S&P growth rate to be as of right now. Any thoughts, any comments?
Yeah, I think it's interesting that most of the time stocks and their reports surprised to the upside, right? And I don't know if that's a thing that, these analysts are just being extra conservative, which
or the companies being
totally
conservative,
get, or the companies being conservative with, they kind of like to, under promise, over deliver type of a situation and surprise to the upside. So, 37 out of the past 40 quarters, that's a pretty strong trend in the S&P 500 beating earnings expectations.
Yeah, and I think it is pretty normal for companies to try to not get too over their skis and set these crazy high benchmarks, because the street wants consistency. They don't want you to miss hugely one quarter and then beat hugely one quarter. It's like, hey, let's try to give us the middle of the road. That's what Wall Street wants. So there's definitely a little bit of that coming into this, but an interesting stat nonetheless, which leads me into my second piece, which is earnings expectations by sector. I picked this up from briefing.com research on the 10th, and this was a bit of a longer piece. Great read if anyone wants to take a dive. So I just took a little bit of a couple pieces out of here. And interestingly, analysts increased their estimates by about 1% heading into Q3 earnings. So every quarter, as you get closer and closer, and you've kind of grabbed all of the information you can out of these companies, analysts will sit down and kind of do their final estimates. And most of the time, analysts will actually lower their earnings expectations. That's a little bit more standard, where they're kind of like, you know what, we all got a little ahead of our skis, and like we're just gonna drop down the benchmark a little bit. This time, they actually increased the estimate. So the last time that estimates were increased on a whole for the S&P was Q4 of 2021. And again, when we're talking about this, we're talking about estimates on average across those 500 companies in the S&P. So interesting just to see that most of the time they get lowered. This time, analysts have actually increased estimate by 1%. When we think about what's been going on in the market, there's been a lot of talk about multiple expansion. I don't even need to go into all that. I'm sure listeners have seen the headlines. The forward 12-month PE multiple is around 23.0x essentially, and we're not going to go into that because I know that's poking Mark's buttons a little bit.
Market's been overvalued for the past 20 years, apparently.
Apparently, yeah. So what does that mean, right? Okay, the multiples have been expanding. Now we get to Q3 ahead of a historically strong quarter. And now estimates for the earnings are going up. That means we expect earnings to be very strong.
Yeah.
All of that is just a perfect cocktail to say we expect earnings to be very strong. So where's the strength going to come from? Where do we think the strength is going to come from based on what we know right now? Not surprisingly, tech and financials are the two biggest ones. So tech contribute to a little more than half of the overall growth rate. So their contribution total, go back to that 8% that I told you in the first research piece, they're about 4.5% of that. So a little over half. Whereas the financials are about 2.2% of that. So you have about over 2/3 coming from those two sectors. The weakness is, and this is again of that growth rate, of that 8%. So tech, financials, we expect to be very strong. The sectors that we expect a little bit of weakness from, energy, consumer staples, consumer discretionary, healthcare sectors are expected to be slight detractors. Energy, somewhat notably. But again, that's cyclical and has to do with the price of the commodity, et cetera. So to be expected with that. So anyway, that's kind of the earnings expectations by sector and just kind of painting the picture. I will say that we have had some earnings this week, as we've mentioned throughout the podcast, and thus far it's been very strong. The banks have done well. We've seen some pretty notable moves for some big names, which is a good start.
Yeah, I think so too. And I just want to go back to a point that you made just a couple moments ago, in that when we do have a really strong quarter for the market, like we did last quarter, you do expect earnings reports to be strong, because you got to remember that all of these analysts and these economists are talking with these companies, you know, in the quarter leading up and getting information out of them. And if you see people get extremely bullish on a company because of what someone in the C-suite has told them, you'll see a lot of buying in that stock. And then it's confusing to people, though, because then once earnings are reported and they blow earnings out of the water, they're growing earnings at 30% per year, revenue's growing at 50% per year, and then the stock's down 15% after earnings. Why is that? And in my opinion, it's profit taking. It's like these guys made what they wanted to make in the past quarter leading up to it. And it's, you know, one of Matt's favorite sayings is buy the rumor, sell the news, right? So you're buying the rumor with the anticipation and hype that earnings are going to be really good. And then once the earnings news actually gets here, it's like, okay, we came in and got what we came for, type of thing.
Yep. Take some profits and kind of reset. And then it could also be, hey, maybe the earnings were good, but they weren't as good as we were expecting. And so the street gets a little, there's some psychology there, and they're like, oh, did we overbuy it? And so you've got a little bit of that. And then the profit taking kind of jumps on top of that. So yeah, it's buy the rumor, sell the news. We could definitely see that trade coming into the market. I think more than anything from a catalyst perspective that we were talking about earlier, if the earnings in general are strong, if we do hit that 8% overall, I think that's a really good thing for the market. I think if we fall below that, I think, there could be a bit of a pullback. I think you could see some volatility jump up, generally speaking. And it's going to come in pockets and waves, because earnings season it's not, it's not like they all report on one day or all the tech reports in 1 week. It's not like that. It's spread out across a number of months. So you'll see little pockets of volatility here and there, which we expect every quarter, pretty much throughout the whole year. That's how the markets go. So my last little piece here is just another one that I thought was kind of interesting. This is Bank of America research, and this is from an ex-post from Mike Zaccardi on the 4th, little bit older, but still, I just thought it was interesting. And he grabbed a chart from Bank of America research and says small cap earnings growth is now positive, and it's expected to eclipse large cap earnings growth in the second half of 25 and 2026. And that just kind of jumped out to me, because, we haven't talked a lot about small caps earnings growth
Over the past 4 years.
Particularly eclipsing the growth of large and mid caps. And yeah, that just, I kind of had to double take when I saw it, and I looked at the chart and I was curious. So I went into some of the comments, and some of the comments were like, no way, it's not going to happen. And so we'll see. I just thought this was interesting. I mean, this is coming from Bank of America's U.S. Equity and U.S. Quant Strategy Department, and very, very smart people over there. So it's just interesting to see that.
Yeah, well, I'm glad that you brought it up, because you're also seeing this in the stock charts, right? So you're seeing on a relative basis, when you compare small caps to large caps over the past couple of months, small caps are starting to outperform their larger cap peers. And like I just said, we have to remember that for 4 years, small caps, mid caps, micro caps have gone nowhere. They still, up until yesterday, I think micro caps made their first all-time high since 2021. And we have to remember, those are some of the most risky stocks, most volatile stocks that you can invest in. So when those names start pulling their weight, I'm not saying it's impossible, but I find it hard to believe that the market can be really weak with those names making new all-time highs over the next 4 to 6 months or whatever it is. So yeah, I always like when the the fundamental research that we read or that you bring to my attention kind of lines up with what the price action is showing me in the market. And
It's always nice.
this is a perfect example of that. So I think it's just going to be really interesting to see what happens, to see if this is more of just a shorter term correction in that trend, or if it's the start of smalls outperforming for a prolonged period of time. So
yeah, very interesting nonetheless.
Yeah. Well, thanks for bringing that up. Moving on to the financial planning topic of the week. This was an article from Sean Jackson at Kiplinger titled Using 10-Year Treasury Yields to Better Understand Mortgage Rate Moves. And there's also some commentary from Kitsis.com on here. And I think this is a good topic to talk about, Nick, especially with the Fed cutting interest rates. People want to know why their credit card rates, their mortgage rates, their auto loan rates do not fall in lockstep with the federal funds rate, the rate that the Fed controls, right?
Yeah.
And it's really confusing to a lot of people. So I thought this was a good article that did a pretty good job of.
This is an excellent topic for listeners.
Yeah. So they say financial market participants pay close attention to the actions of the Federal Reserve, particularly its decision-making around setting a target range for the federal funds rate. And again, as a reminder for listeners, the federal funds rate is the rate that banks lend to each other overnight. It's a very short-term rate, but that influences the rest of rates in this country. So they say while the Fed's recent rate cut decision brought cheers from equity investors, individuals looking to purchase a home or refinance a mortgage might have been disappointed that the rate cut decision wasn't followed by a sharp drop in mortgage rates. Something a lot of people don't realize is that a decline of 33 basis points or 0.33% in the federal funds rate historically has resulted in only a decrease of about 10 basis points or 0.1% for the 30-year mortgage rate. So it's not one for one. One reason for this is that mortgage rates are less correlated with the short-term federal funds rate and more correlated with the yield on the 10-year Treasury bond, in part because the duration of these rates on the 10-year bond reflects the average mortgage. While the Fed's actions play a part in determining the rates on the 10-year by signaling future direction of monetary policy, other factors include investor expectations for inflation, with investors typically demanding a higher rate of return if they expect a higher inflationary environment going forward, as well as expectations for economic growth, with a high growth environment making equities look more favorable, potentially leading to higher rates to attract demand for government bonds. Another key factor in determining mortgage rates is the mortgage spread, or the difference between the 10-year Treasury yield and mortgage rates, which has historically been between 0.7 to 1.4 percentage points, although it's at about 2 percentage points today. The overall spread is made up of a primary spread, which factors in mortgage origination fees and other lending costs and profits, and a secondary spread, which accounts for the risks, so default risk, prepayment risk, that investors in mortgage-backed securities face, but Treasury investors do not. And I think, to kind of just touch on mortgage-backed securities really quickly, I think, I've had it happen to me where I had a mortgage with a company and then they sold it to another company. So, these mortgage-backed securities where they package a bunch of mortgages and sell them to other investors, that's not uncommon to happen. So obviously there's more risk there than just investing in a 10-year Treasury bond, right?
Right.
So for that risk and for people to take on that risk of homeowners, the mortgage rates are higher than the Treasury rate, right? That just makes sense. We talk about that all the time. So I just thought this was really interesting because a lot of people are scratching their heads right now. Yeah. I think it's probably pretty obvious why when the Fed raises interest rates, why companies are so quickly to raise their rates because it behooves them to do that.
Yeah.
But regardless, I thought that this was a pretty simple to understand article that may answer some of those questions. If you are a homeowner, or if you own a car, or you're worrying about your interest rate on your credit card, and so on and so forth.
Yeah, I think just to kind of reiterate one of the key points to think about is when you see the headline news of the Fed cut by a quarter cut, a 25 bip cut. It's going to take 3 or 4 of those before you could see a notable change in the prime rate and your financing rates. And it will take time for that to kind of filter through the system, as you were talking about, because it has to do with capitalism and all the different people along the chain that they need their margins to improve across all these different channels before it hits you as the end consumer.
Right.
So it's just it is a function of that, where it's like they're not just going to give you a deal and because they're like, oh, the Fed's definitely going to cut in a couple, they're going to have 3 cuts and over the next 4 months. You guys have heard us talk about how often that changes.
Right.
So they're not going to go out and say, we'll give our customers a deal for 30 years. It's not. They need to lock in their profit margins along every length of the chain, and
right.
it takes time, unfortunately, which is really tough when you're buying a house or you're looking at your credit card interest and things of that nature. But that's a piece of it. That's why it's a bit more of a patience and a planning and budgeting, financial planning, and all of that is so important. Is because that long-term stuff, it does not move quickly.
Yeah, one of the most frequent sayings I hear is, I'm just going to wait until, rates come down to buy a house. And it's like, okay, but you might be waiting a lot longer than you think.
5 years.
5 years.
Maybe longer.
Right.
Yeah, it moves slower than we as consumers, especially nowadays, because I think as consumers, we have been continuously put through this short cycle of psychology where I just pull out my phone and I can order something and it'll be sitting on my door sometimes in the same day. I mean, we have this short cycle of expectations, and this is an area of consumer spending, you could say, I suppose, buying homes and financing, that this is not going to change anytime soon from what I can see, because it's just a function of capitalism, really.
Right.
So,
yeah. Well said.
Sorry to burst the bubble there for anybody, but it's important. That's why you have financial planners and plan this stuff out. So.
Yeah. Well said. We appreciate that, and thank you everyone for listening to episode 322 of the Independent Advisors podcast. We will be back with you next week for episode 323.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.